welcome to Market Domination, sponsored by Tasty Trade. I'm Julie Hyman, that's Josh Lipton, live from our New York City headquarters. We're giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
Going into this year, we're bullish. We thought the market would be up double digit, 15% or so, and we've exceeded that so far. Again, I would go back and say, you can't always predict exactly the timing of the gains. And I think that we could have a bit of a surge and a melt up to 6,000 plus.
We're in a second or third inning, maybe fourth inning of this AI move. And really the epicenter of all this is Nvidia. And the CEO just said, and gave you a fat pitch, our sales are insane. Stock gained probably about 14, 15 points since last Wednesday. So I still consider Nvidia to be a bellwether, though their earnings are a little bit funky. It comes in the third week of November.
When you say Nike, you are like the number one in whatever sport it is. That is very, very rare for all these other, even the up-and-comers. They're a running specialty, but there's not an image of like the number one, the gold medalist, right, on that platform. And that's really what Nike has to get back to.
We got 1 hour to go until the market close. So let's take a look at the major averages here. We got, guess what, more records today. The Dow right now is up 207 points or so, about a 0.5%. The S&P 500 after closing at what? Its 45th record of the year is up again today. So once again, record today. And the Nasdaq also strong, up 0.9%. Of course, we should mention it is a holiday for some today, a bank holiday. The bond markets are closed, so volume's a little bit thinner than usual. But with the Nasdaq going up today, there's I'm going to ask you, hit that stock.
Look at that.
Oh, you did it. Look at you.
Amazing move.
Is Nvidia trading at a record today?
Yeah, so Nvidia is interesting. It wasn't so long ago, there was some current concerns about product delays, right? You had some worries popping up, but investors have piled right back into this name. It's up already this month, around maybe 12, I think 13%. What a move. And just a lot of excitement about the new Blackwell chip. It helps when the CEO comes out and says demand is insane, his words, and obviously that has folks feeling more comfortable and confident. A lot of people still believing this is the smart way to play that AI theme. Yeah,
we're going to talk to a smart person about that later on, Stacey Raskin, analyst who has been a bull on Nvidia. The shares, up 180% year to date. In terms of what else we're watching here today, we're just looking ahead to earnings, right? We're not going to get earnings from Nvidia for a long time, but we are going to get a lot of companies reporting this week. 51 S&P 500 companies are going to be reporting over the course of the week. More financial firms are going to be coming out. Bank of America, we're going to hear from Goldman, Morgan Stanley, but a lot of other companies over the course of the week as well.
Yeah, very early days, but so far, I mean, you'd have to say relatively good results. I would say one interesting part is how we've had some strategists and investors come on, Julie, and say they're not concerned about this quarter in terms of expectations for profit growth. I did think it was interesting some of the commentary about how they're looking ahead now to 2025 and the expectations for bottom line growth at that point and whether that kind of double-digit expectation is in fact doable.
Well, and what's also interesting is that a lot of strategists have been cutting estimates for earnings growth for this quarter that is currently being reported. But if you listen into the companies themselves, they're very bullish. So there's that gap in perception. We'll see what happens as we start to get more and more of the numbers. And speaking of a gap in perception, who knows day to day what the Federal Reserve is going to be doing? Neil Kashkari of the Minneapolis Fed today saying that he expects modest interest rate cuts in the coming quarters.
Yeah, it gets the backdrop of, I mean, you did have a measure of inflation in September that was tick hotter than some expected. Meanwhile, labor market data seems to suggest labor markets, holding in there. And so you have seen investors kind of dialing back expectations of the size of the next cut. So it was interesting to hear Kashkari talk about modest cuts coming.
Yeah.
Let's get more perspective on what investors should be watching for here this week. Let's welcome in Liz Young-Thomas, SoFi Head of Investment Strategy. Liz, always great to have you on the show. Start big picture here, Liz. 2 years for this current bull market. Gains have been impressive, Liz. Do the good times continue?
It has been a really impressive run, and I think it can continue for a while, but we have to keep in mind that we're in a usually volatile period, and obviously leading up to an election brings in all kinds of uncertainty. So I think what we're seeing right now in both the stock market and the bond market is that people have decided that a soft landing is all but secured, and at least we're comfortable with the idea that GDP growth has stayed strong. Inflation, although is coming in a little bit hotter than expected, still reasonably under control. And we haven't seen these big cracks in the labor market that many feared either. So the way that the data is showing right now is that things are good. The economy is in much better balance, which is what the Fed wanted to see than it was a couple years ago. And if we could just freeze it in time right now and keep the data at these levels, things would be good. The stock market continues to celebrate that. I think there has been some confusion in stocks about whether or not we want the Fed to be dovish or we want them to be hawkish. And now by the end of this year, not even sure that we're expecting another 2 cuts, and that's what's priced into the market. So what I would say big picture is on any given day, though, don't get married to what the market is expecting the Fed to do because it swings so easily, and we still are hanging on each of those data points, particularly the labor data points, as the rest of the year progresses.
So we've been hanging on those macro data points, but now, of course, we're coming into earnings season where we're going to be focusing more on the micro and the individual companies. And Bloomberg pointing out in a story today this interesting gap that I alluded to earlier between what strategists are expecting and what companies are saying. And we have a lot of negativity that earnings revisions have been going downward. They've been cut. So does that then set us up well for the earnings season that companies are going to come out and beat?
Well, I think the market has expected that for many quarters in a row, and the bar just keeps getting higher, where we're expecting beats from companies, and if they don't knock it out of the park, it ends up to be some sort of disappointment, and the stock price gets punished. I think if we're painting with a broad brush, which obviously there are going to be exceptions to every rule, but if we're painting with a broad brush, I think company management has been pretty careful not to set expectations too high. So there has been a decent level of management of those earnings expectations. And now you do have strategists and analysts doing some sort of backpedaling on what earnings strength might look like. So we're at a point where we're expecting somewhere between 4 and 5% earnings growth this quarter, which is a far cry from what we've had in previous quarters, but still positive and still moving. And this could be just a period of time where earnings growth is a little bit less inspiring compared to the past. But if we're in this normalization process, a normalization in rates, a normalization in inflation, normalization in the labor market, you don't get to pick and choose what normalizes. Everything has to normalize with that because it is all connected. So if earnings growth comes back down to earth for a while, only to pick up later, that is typically what has been the expectation. So we're seeing analysts sort of pull back on strong growth expectations for the next few quarters, and then they pick back up again in the latter half of 2025.
Liz, let me ask you about another big theme we're talking about, which is China. You had the weekend press conference. Government over there wants to support the economy. Are you bullish on Chinese equities, Liz?
Look, I think that the announcement of stimulus was a positive. I don't think that it's the end of the announcements of stimulus. And what the market was looking for over the weekend was something more specific, perhaps something bigger to pile onto the stimulus that had already been announced. So it was interpreted as a bit of a disappointment, or at least a lack of more details. So I think China still has work to do. The economy still remains in a deflationary status, and that's an important thing to get the economy out of if you want a stock market that can rise and stay up. So what's happened so far is the announcement of the stimulus drove a lot of optimism in the stock market, but almost too much, and it overshot on the upside. So we've seen some give back there. I think if China continues to stimulate in a targeted way, particularly at the property market, we will see more upside after that.
Something else that you have been writing about as of late, another asset to look at, Liz, is gold. And gold has done really well this year, maybe counterintuitively, maybe it makes sense given the sort of global turmoil that we've been seeing. But I guess the question is now, does it continue to perform in the same way?
So I think there is still more upside for gold, and it seems to be one of those forgotten assets. But interestingly, gold has outperformed the S&P year to date, trailing 1 year and a trailing 3-year basis, which is not normal. Usually gold is not up as much as the S&P over longer term periods. So what's happening, I think right now, there's a number of different forces at play. We've got some big central bank buyers that have propped up gold prices. There's been some currency volatility around the globe, and I'm not convinced that that's over yet. So I think that there continues to be a bid for gold because of that. And it is traditionally a safe haven asset. It's something that investors would look to in the case of recession fears. But the interesting part of what's happened with gold is that even when recession fears abate, gold continues to go up. The last part of this that leads me to believe there is still upside is that there actually is not a lot of retail participation in this trade yet. And I think there's still room for individual investors, retail investors to get into the gold trade, and we could see it climb even higher.
And Liz, would you rather own the metal than the miners here?
They're going to act differently, and the miners have been disappointing compared to gold over the longer term periods if you look at the last 10 years or so. But in an environment where gold is hitting new all-time highs and you've got a cost structure in the miners that's really dependent on energy prices. So as energy prices have come down, that saves the miners money, and they've had room to run and really play in this catch-up trade. So I think you can own both, but always remember that you should expect more volatility out of gold mining stocks than out of the commodity itself.
Liz, good to see you. Thanks a lot. Appreciate it.
Good to see you too. Thank you.
Well, from one commodity to another, let's talk about oil. Oil prices lower today as OPEC has cut its forecast for global oil demand growth in 2024. Here with more, Yahoo Finance's Inez Ferre. Hi, Inez.
Hi, Julie. That's right. And oil today down about 2%. A lot of this has to do with China. And you mentioned OPEC reducing its oil forecast for 2024 and 2025. By the way, this is the third consecutive month that it reduces its forecast. And this is over weaker demand growth coming from China. China has been moving more towards EVs, the use of natural gas also, which is seen more as a cleaner type of fossil fuel. Futures also today reacting to commentary over the weekend from China's foreign minister about their stimulus, and really the lack of details that traders have been talking about, lack of details or any new big incentives announced. One analyst said, look, China is the biggest oil importer, and naturally, if you do have a downturn there, a recession there, he believes that the stimulus won't really help long term. So he's saying you're going to be adding more oil onto the market. And all of this, of course, with the backdrop of the Middle East. I just want to point out on our Wi-Fi Interactive, since the beginning of October, we have seen oil up about 8%. So we've seen quite a bit of volatility month to date. Up 8%. Even a week ago, you saw that the prices had gone up to levels not seen since August. Spare capacity from OPEC, that is what is keeping oil prices at bay. So even though we did see oil pushing above $80 per barrel for Brent, the reason why it didn't even go higher than that is partly because of this spare capacity from OPEC, guys.
Inez, thank you. Appreciate it. We're just getting started here on Market Domination. Coming up, Bitcoin climbing above $65,000. We're just weeks away from the presidential election, and Kamala Harris now chiming in on a framework for crypto. We'll be talking about that next with the strategist from Bitwise. And Nvidia shares on track to close at a new all-time high. Are they still the best buy in the chip market? We'll have more on how to be positioned among the tech giants later in the hour. Stick around. Market Domination continues right after this. Now, time for some of today's top trending tickers. You can scan the QR code below to check out the best and worst performing stocks of the session on Yahoo Finance's trending tickers page. And first up, taking a look at shares of SiriusXM as Warren Buffett's Berkshire Hathaway increases its stake in the company. Berkshire now owns about 32% of the company here. $86.7 million worth of additional stock is what Berkshire bought here. And that was about 3.6 million shares. So when Berkshire has a vote of confidence in your company, it tends
The
to be that
greatest
other
value
people
investor of
follow.
all time.
Yeah.
Gives you a thumbs up. It helps. I did reach out to Matt Harrigan at Benchmark because Matt covers the name. Here's what he told clients: says, we are admittedly somewhat surprised by the ferocity of the move given Berkshire's already material holding. Goes on to say we have high conviction that SiriusXM has a durable U.S. audio leadership position. Talk about different opportunities, including, they call out, a younger demographic appeal, Julie.
I mean, it's interesting when we talk about, Buffett as this great value investor. I mean, the stock is down
50% this year.
50% this year. But obviously, he doesn't buy everything that's fallen a lot, so he has to see some value there. Maybe it's the youth proposition you're talking about. By the way, the company reports earnings on Halloween. We will see if they are spooky or not.
We'll see. We will see. All right, turning to the health sector, Hims and Hers shares rising in today's trade. That's as regularly as say they would reconsider limits on compounded weight loss drugs. So jumping here, about 6%. We know they've been selling compounded obesity drugs. Reports now that the FDA, Julie, reconsidering its decision to pull Eli Lilly's blockbuster weight loss and diabetes drugs off the shortage list. So the FDA would allow compounding pharmacies, facilities to keep offering the drugs while it reviews whether there is this shortage of this active ingredient.
Yeah, there's a compounding industry group. Compounding is these pharmacies that sort of put these drugs together themselves with the active compound in them. The Outsourcing Facilities Association had sued the government to prevent them from putting the drug on that list. And it seemed like, again, there was this reporting late Friday that the FDA was reconsidering that decision. Tirzepatide is the ingredient that we're talking about in these GLP-1s. And a lot of other companies besides the Eli Lillys of the world have started to really make a big market in selling this stuff. Hims and Hers is one of them. The shares are up a tidy 124%. This year, in part because of adding this to their roster of drugs.
Yeah, I was just looking through some of the this commentary on this. In terms of those, at least on the sidelines, for example, they were telling clients that the FDA's decision to review the shortage, they were saying, allow compounding pharmacies to keep manufacturing its compounded version, bode favorably for Hims and its compounded GLP-1 offering. Clearly, some investors agree, at least right now.
And we got another pharma mover as well. This one is called Longboard Pharmaceuticals. Those shares skyrocketing, and that's after Lundbeck, of a Danish company, agreed to acquire it in a strategic deal. The acquisition aimed at enhancing Lundbeck's capabilities and presence within neuro-rare conditions, and specifically for some rare types of epilepsy. Longboard has some drugs in its pipeline that are aimed at treating that Lundbeck now wants to get onto the market by the final quarter of 2028.
I saw the CEO telling press the deal will help build a late-stage pipeline for Lundbeck, says this has blockbuster potential and apparently open to making even more acquisitions as well. So
yeah,
we'll see.
They're talking about $1.5 to $2 billion when it reaches peak sales. What I find fascinating about Longboard, as a quick aside here, the company went public in 2021 at $16 a share. And when we talk about trending tickers, we frequently see relatively small biotech companies on there. This is like the dream scenario if you are a speculative biotech investor. Now, it's had a lot of ups and downs, but the stock went public in 2021, as I mentioned, at $16 a share. It's now trading close to $60 ahead of being acquired here. $60 a share is where it's being taken out. And obviously some of these stocks do not turn out well. They don't get acquired. Their drugs don't work. But this is an example.
You're in this space. I mean, how just one headline sends you shooting higher or nosedive. It's amazing. But good for those shareholders.
Yeah. All right, well, let's talk about crypto as well. That's on a high to start off the week. Bitcoin climbing above $65,000 as we're just weeks away from the presidential election, and U.S. Vice President Kamala Harris voicing plans to establish a regulatory framework for crypto. Here with more on the latest, Bitwise Asset Management Senior Investment Strategist Juan Leon. Juan, as we are seeing Bitcoin climb here, the narrative has shifted, and it's been quite interesting to watch, because initially it was seen that a Trump presidency would be much more positive for cryptocurrencies. Now it seems like that Kamala Harris is trying to also capture some of the crypto vote. Is that sort of what's helping boost crypto here, that it's going to work out no matter what?
Hi, Julie. Surely Harris's recent fundraiser was positive. You know, she talked about in her administration investing in America's competitiveness, encourage innovative technologies like AI and crypto. And that was welcomed by the industry, and because it's a departure from the Biden administration's adversarial stance on crypto and AI. And I think the market is reacting positively as a result of that.
Do you think, Juan, it's about Harris or is it about Trump? I'm curious to get your take on there because, listen, Trump clearly positioned himself, as a strong friend of the crypto industry, trying to win over crypto votes. I see these reports that prediction markets have really flipped here in the last few days, Juan, now assigning Trump greater odds of a victory. I'm wondering if you think that is actually perhaps a tailwind here for Bitcoin and why we're seeing the moves we are.
Yeah, the Trump administration has thus far engaged much more with the industry. Trump has explicitly said he would replace Gensler if he came to office. He wants to make the U.S. Bitcoin mining capital of the world, create a strategic stockpile for Bitcoin. So he's been more explicit about how he would engage with the industry and support it. But given the recent comments and change of stance from the Harris administration, we're optimistic that Harris could also be supportive for the industry, and certainly more supportive than the Biden administration could be. The Harris administration has been engaging with industry players, and I think they're coming about understanding the opportunity that the industry brings for the future of America and the economy.
Well, obviously cryptocurrencies and Bitcoin are still relatively young assets. But can we look at past presidential elections since Bitcoin has been in existence? I mean, we talk all the time about how equities tend to perform in election years. Is there any kind of pattern with Bitcoin?
Bitcoin has actually tended to do very well in the year post-elections and has generally seen a very positive upward momentum. We've seen increasing regulations around the world that have favored crypto over the past couple of years. The U.S. Is behind other jurisdictions, but we've seen regulations come in Europe and in Asia. And so we are seeing an increased trajectory towards more regulatory clarity. And alongside that, we're continuing to see upward adoption of Bitcoin and other cryptocurrencies around the world. And they're really growing at a fast pace. So elections tend to be, markets hate uncertainty. And so leading up to elections, it tends to be more volatile. But after you get clarity about which administration is coming and things sort of fall into place, the upward adoption of cryptocurrencies and the technological adoption that it's providing continues. And that has generally played favorably post-elections.
Juan, I'm also curious, China, obviously, taking steps, stimulus, they want to support their economy. Has that proven, do you think, to also be a tailwind for Bitcoin? Is that another reason we see it moving higher here?
Yeah, absolutely. You saw Bitcoin rally not only with China when it cut rates and provided a stimulus to the economy, but when the U.S. cut rates as well. Zooming out of the election outcome, we're seeing bills with bipartisan support move through Congress in the U.S. We're seeing a global economic easing cycle with central banks cutting rates, governments stimulating the economy. At Bitwise, we have onboarded a record amount of clients this year who are investing in Bitcoin and Ethereum via the ETFs and are excited about what other assets may be approved in that ETF wrapper for them to access going forward in the next 4 years. So we're seeing great momentum in the industry. We're seeing continued innovation. Stable coins are gaining traction, new blockchains that are launching for specific use cases. We're seeing established institutions from BlackRock to Sony building on top of blockchains. So we're really seeing the industry cross that chasm into the mainstream adoption And that has us very excited at Bitwise.
Juan, great to have you on the show today. Thank you so much for joining us.
Thank you, Josh.
And coming up, earnings season will be front and center this week as the big banks kick off another round of reports. We're going to speak to an expert on the other side about what to expect from the likes of Bank of America and Citi's latest numbers. Stick around, much more market domination still to come.
Banks kicking off another earnings season. We already saw positive reports from JP Morgan and Wells Fargo on Friday. But what are investors expecting tomorrow from Bank of America and Citi? For more and for the big picture, we're bringing in Saul Martinez, head of U.S. Financials Research at HSBC. Saul, thank you for being with us. So we heard from JP Morgan and Wells Fargo, and the takeaway there seemed to be that net interest income was perhaps not the sort of thing dragging them down that investors might have expected with rates coming down. Is that the big picture, and is that also going to apply for the other money center banks?
All right. Well, thank you for having me. I think that is probably the key debate in the sector right now. And I think that what was encouraging to a lot of investors about JP Morgan and Wells Fargo's results is that there is light at the end of the tunnel for net interest income. And we have been seeing these trends. Deposit cost pressure have been moderating. Both Wells and JP Morgan talked about yield-seeking behavior from depositors moderating. You are seeing the benefit of higher long-end rates filtering through the balance sheet. So with both, with these banks, The question is, do we see a trough in net interest income in the second half or in early 2025? And do we start to see growth again in net interest income next year? That's a critical question, because if you do start to see net interest income growing, which is the biggest revenue component of banks, you start to get an outlook that allows banks to post positive operating leverage and improving EPS momentum and ROTC momentum. So I think in the case of Bank of America, especially tomorrow, that's a key driver. What they say about net interest income in the fourth quarter and into 2025, and whether they continue to see that improving in 2025, is going to be a really important determinant for how the share price reacts.
And so we're now waiting for Goldman and Morgan Stanley as well. What are your expectations for those results?
Yeah, look, I think one of the takeaways from JP Morgan's results was that we had, really strong investment banking results, and they, it's one bank, so it's, your sample size is small, and you have to caution a little bit about drawing conclusions from one report. But JP Morgan had 15% or talked about 15% year-on-year growth in IB about a month ago, and they delivered 31%, highlighting that late in the quarter there was some strong activity. So that could bode well for Morgan Stanley and Goldman Sachs on the investment banking side. We're expecting Goldman to grow investment banking fees 15%, Morgan Stanley a little bit stronger at 41% off of a weaker base. But we think the quarter could be, you could see good activity in debt capital markets. ECM will grow off of a low base, and M&A seems to be improving on the margin. So we do think the capital market side will be good. I think with Goldman, it'll be a messy quarter, but I think it generally reinforces a positive narrative of self-help, improving results in asset and wealth management, and I think that will rule the day tomorrow for them.
As an investor right now, given that sort of strength in investment banking in particular, do you think investors should be more focused on, say, a Morgan Stanley and a Goldman Sachs than some of the other big banks?
Well, that's our call. I mean, we favor the investment banks over the traditional banks. We upgraded Morgan Stanley, in fact, about a week and a half ago, for a number of reasons, including we think the earnings revision cycle, which has been negative for a few years, is inflecting. We think the wealth management business is there's some positive signs there in terms of net new fee-generating assets. But the investment banking side is a big piece of that as well. We think they are positively levered to an improving investment banking cycle. We still think we're in the middle innings of that improvement, and that could last a couple of years. Equity issuance and M&A are still below historical averages, and as those improve with rates declining, with limited partners looking to get more liquidity, that also promotes more investment banking activity. And I think Goldman and Morgan Stanley, which we both recommend as buys, are going to be primary beneficiaries. So even though net interest income is improving, and that's a good thing for traditional banks, the revenue outlook we still think is much better for the investment banks.
So what about Citi? That stock has already enjoyed a nice move. It's up about 30% this year. Do you stick with it?
I think you do. We like Citi. We do think that this has a very much a self-help component to it. I think what's important in the results are we seeing dynamics that point to a better profitability outlook over the next couple of years? Can they go from a 6-7% ROTCE, which is very low, to closer to 10%? They're guiding to 11 to 12 by 2026. They don't need to get there. They just need to show progress towards that. So what we like about it is that there's a lot of stuff that is in their control. Expenses. Are they on track to reduce their expense base over the next couple of years? We think that they will show progress there. We do also think that net interest income, like the other banks, will start to improve, and that is a good thing as well. But ultimately, they need to start to show better profitability in their underlying businesses: investment banking, wealth management, their cards business. And I do think if they do that, and I think there is a sense of urgency there that I haven't seen in the past, there is a lot of room for multiple expansion and very strong book value growth over the next 2 to 3 years.
A lot to dig into when we get more of these results. So thank you. Appreciate it.
Yeah, happy to be here.
The AI race appears to be jump-starting a nuclear revival in the United States. Google has just announced it will back the construction of 7 small nuclear power reactors in the U.S. It's a first-of-its-kind deal that aims to help feed its growing appetite for electricity to power AI. The generators will be built by nuclear energy startup Kairos Power, with the companies aiming to add 500 megawatts of nuclear power by the end of the decade. And this, of course, adds on to the news that Microsoft had signed with Constellation Energy recently to restart the 3 Mile Island nuclear reactor. That is due to happen in 2028. So I think it's worth mentioning that here we are in 2024, and these companies are foreseeing enough demand that far out that they are signing these longer term, and in the case of Kairos, highly experimental deals with these companies.
Yeah, Google's Senior Director of Energy and Climate is quoted here as saying it's going to accelerate the transition to clean energy. Talks about how this is a key part of our efforts to commercialize and scale the advanced energy technologies we need, he's saying, to reach our net zero and 24/7 carbon-free energy goals.
So again, to emphasize here, this is an experimental technology. Small modular reactors of this type do not currently exist. And this company, Kairos in particular, is aiming to develop a demonstration version by 2030. And then this would be in place for Google, in theory, by 2035. They also don't use water cooling for these SMRs, as they're called. They use a kind of salt cooling, if I understand it correctly. My understanding is rudimentary. So there is this sort of next frontier in nuclear power technology, but we're not quite there yet. It's just interesting to see now big tech investing in this area. Yeah, we will.
All right, here's another thing we're watching. Nvidia jumping today, set to finish at an all-time high as it closes in on reclaiming the #1 spot atop the market cap mountain. This coming as the chip maker seems to have cornered the market with Blackwell demand soaring and rival AMD's latest chip disappointing investors. So how should you be positioned among these big chip names? For more, I want to welcome in Dr. Stacy Rasgon, Bernstein Managing Director and Senior Analyst. Stacy, always great to see you. So let's talk NVIDIA here. This stock, Stacy, is up about 14% already this month. I'm sure it helps CEO Jensen Huang when he's out there, Stacy, saying, you know what, demand for my Blackwell chip, it's insane. That's his word.
Yeah, he's not holding back, is he, right?
He is not. But what do you make of this move, Stacy?
I'm sorry, what was that?
I just said he never does.
No, he doesn't. Sorry, what was your question?
Walk us through the move, Stacy. Is it justified in your opinion?
Yeah, look, so, the stock, if you go back a couple of months ago when they reported earnings, the stock sold off a bit after that print. And it actually wasn't really because of the demand. It was because of the gross margins. They had suggested margins come down a little bit into the end of the year, primarily on mix, by the way. And it's because a lot of these new products are starting to ramp and they're very complex and they're not cost optimized yet. And as people have, kind of done more of their checks as you go through the quarter, and we met with them and everything else, it's very clear for a few things. One is that, the margins, they're not coming down a lot. They're still well into the 70s, like they're fine. And the demand, like with every day that goes along, it just looks like it's getting better and better and better. And you're right, Jensen was out, I think, on CNBC or wherever, talking about it was insane. And, they're looking for material amounts of new products to ramp as we go from Q3 to Q4 as that product hits the market. But even the older generation stuff, the older Hopper chips, our demand is still off the charts, so that's still growing. And then you couple that, AMD had their event last week. And again, I always say this, I don't want to knock AMD, like they're doing very well for where they were coming from. Like this business for them might do $5 billion this year. It was zero a year ago, so that's fine. But if you look at kind of the roadmap that's going forward, and you look at some of the specs they put in for their new product, it's called the MI325 is the new one. It barely stacks up against the Hopper chips that NVIDIA has been shipping for a year and a half, 2 years. And the new NVIDIA chips, the Blackwell chips, the new stuff, I mean, it's night and day in terms of the capabilities of that. So the gap in terms of timing between what NVIDIA is delivering, what AMD is delivering is still very, very wide. I think it's still NVIDIA's game to lose. And then I think finally, it even gets with some of the comments you just made about Alphabet and nuclear reactors, and people are foreseeing demand continuing, and they're actually making investments to enable that. And with all these stocks, like there's a big worry that just the numbers have gotten so big so quickly, they're just worried about sustainability. And But clearly everything we're seeing from the supply chain and the customers, it doesn't suggest that there's any sort of faltering of demand anytime soon. Quite the opposite. So I mean, that's what's been taking it up.
Well, and I think that's a really interesting and important point that you make, Stacey, because I think part of the sort of pullback in Nvidia stock, perhaps in addition to there being questions about supply and demand, et cetera, was this idea that all of the demand is being soaked up by the hyperscalers. They're that sort of middleman, if you will. But it seemed like there were questions about where it goes from there, what their customers are doing, how their customers are using it. And it doesn't seem like that question has necessarily gone away, but maybe it doesn't matter if the hyperscalers are just buying everything they can.
So it's not all hyperscalers. I think NVIDIA themselves, I can't remember the number, 45% maybe of their revenue right now was what they called, large cloud vendors and consumer internet companies. So kind of those guys. So it's not all going to them, but a lot of it is. And clearly they're the ones with the deepest pockets and they can place the biggest orders and it can be lumpy. For now, at least, they can continue to spend. They're kind of in almost like an existential arms race, right? I think Google's CEO did put this. He kind of suggested that the risks of underinvestment were much bigger than the risks of overinvestment. And so as of right now, they can continue to spend. Now, certainly over time, there needs to be a return. And clearly, if it turns out there's no return, all this stuff, then the whole thing comes crumbling down for NVIDIA and frankly, probably for everybody, both in and out of semis, right? However, though, I don't think that is really in question. I think that there is a return, and return can come two different ways. It can be driving revenues and new business models that drive revenues. It can also be driving productivity. At least in the near to medium term, the large hyperscalers can spend even if the return is not there. They generate hundreds of billions of dollars of operating profit every year. Like they can afford to spend if they think it's existential. Over time, clearly, you do need their customers, enterprise customers, to adopt. But we're already seeing like data points, like you've had companies come out and talk about productivity savings. We've got other ones. It's still early days, right? We're still in the experimentation phase. But I think the general signs that people are actually like building with this and working with, I think are still there. So I think it's early. And I think if we're asking ourselves, this question 3 years from now, like what is the return? I think we have a problem, but I don't think we're anywhere near that. And for now, I think the demand is still off the charts. They're going to keep selling everything they can make, at least for now.
Stacey, I'm going to end here with a question about Intel. Their earnings, of course, coming up shortly here. I'll double barrel this one, Stacey. One, do you believe in Pat Gelsinger's strategy for this company? Do you believe in his vision? And two, in your opinion, is he the right man for the job?
Oh, look, so like, what is the strategy? The strategy is to double and triple down on manufacturing and build out all of this capacity to become the leader in semiconductor manufacturing and to build products for other players. And the real problem, we can argue if the strategy itself is right or wrong. My issue is I don't think the core business that they have supports their path to get there anymore. And that's really the issue. The problem with building a foundry business is it takes tens of billions, maybe even hundreds of billions of dollars of investment over many, many years. And it'll be many, many years before they see revenue from it. And the core business, like the traditional PC and server business that was actually supposed to carry them along to generate the profits that was required to allow them to get to that, the core business is collapsed, right? So it just doesn't really satisfy, it doesn't give them the support they need anymore. But they may be too far along to stop, right? They've already got the CHIPS Act money. And he spent the last 2 or 3 years like doing almost nothing but lobbying Congress to get this money. So they've got that. They're talking about commitments and everything like from some customers. I mean, like what happens if they stop now? Then you're in a position where they still don't have like the wafer like manufacturing scale like to get their own house in order. And their core business in the meantime, they just did a massive layoff. Now they've lost tons of experienced folks and they're losing share, and they were not able to lock on to like the AI trend, which is driving a lot of their competitors. They really got nothing as far as I can see on the AI strategy. So I don't know that it's so much the strategy was right or wrong from the get-go, but I do think the current situation they're in makes it much, much tougher to actually execute on the strategy because they just don't have the runway that core business was providing a few years ago to carry them there.
Dr. Razgon, always great to have you on the show. Thank you for joining us. Appreciate it.
Yeah, you bet.
Coming up, shares of Affirm higher today on the back of a bullish note. We're going to check in on our top analyst calls of the day on the other side. Stay tuned. More market domination still to come. All right, now let's get to some calls of the day here, sponsored by Tasty Trade. Wedbush upgrading a couple financial services companies, Affirm and Upstart Holdings, both from underperform to neutral. The notes citing headwinds from lower rates. So on Affirm, they do upgrade one. They go to neutral. Target's 45, saying a lower interest rate environment should be beneficial to the company on several fronts, including lower funding costs and incremental GMV growth. Go on to say we expect solid credit quality to continue at least in the near term, given our base case is the economy should achieve a soft landing, Julie.
Yeah, and it's interesting here because they talk about that the company has really tried to hold on to solid credit quality, but they do expect the company maybe to loosen its standards a little bit. What I think is really interesting with Affirm is the trend that we have seen. This is the fourth upgrade we've gotten in the past week. A lot of the other analysts talking about profitability on a GAAP basis coming, generally accepted accounting principles. And the consensus is for the company to be earnings per share positive by its fiscal fourth quarter of 2025. We're in that fiscal year now. What's also remarkable to me, the stock is down a little more than 1% year to date. However, it bottomed for the year on August 7th. Since then, it has doubled in value. We have just seen it a rocket ship up from early August. And I think part of that is this GAAP profitability thing. Part of it is rates coming down as being seen as a positive for a firm.
And by Wedbush did upgrade Upstart as well to neutral, highlights improving credit quality metrics, lower rates, says capital markets are the most accessible for credit providers as they've been in 2 years. Risk reward is balanced in their opinion. Target also 45 on that one.
Yeah, interesting. All right, Johnson & Johnson is set to report its third quarter earnings before the bell Tuesday, with revenue projected to increase but profit to slip from the same time last year. The company also predicted to provide an updated full-year outlook after its $1.7 billion acquisition of V-Wave, which develops a number of treatments for heart failure. With just a few minutes left till the closing bell on Wall Street, we're looking at how to play pharma and biotech stocks with the Yahoo Finance Playbook. Joining us now, Chris Shibutani, Goldman Sachs Senior Biotechnology Analyst in Global Investment Research. Chris, it's great to see you here. Let's talk J&J. You do have a neutral on this name, but when you look at the results here, what are you going to be focusing on? Where would be, in your view, the potential upside?
Thanks for having me on, Julie. Yeah, J&J typically kicks off earnings season for healthcare, but also for the large cap pharmas. It really is the beachhead. Many read across sort of results. This is a business of both pharmaceuticals as well as medical devices. I think the medical device business is one that clearly the company has been paying attention to. As you mentioned earlier, that acquisition that they did continues to build upon the cardiovascular base of business here, which has been an element of strength for that business. On the pharma side, very strong, well recognized on the cancer side, multiple myeloma. Immunology, however, is going to be starting now to navigate a period where biosimilar competition will be coming in, first in Europe and then next year in the US. So we have to get through several quarters really for upside on the pharma. I think we're watching closely the strategic moves that the company's been making in med tech.
So you are neutral on this one, Chris. What would be some upside risks you would call out?
Yeah, I think it'll be interesting to see how they manage through this period of exposure to biosimilars. It's still a little bit less familiar territory. We know that once patents end, typically for what we call small molecules, pills and tablets, many generic companies can come in and revenues essentially fall off a cliff, hence the phrase patent cliff. With the injectable drugs, it is more of an erosion. The revenues tend to roll over. And here, many of the sort of less visible dynamics of how drugs get paid for and put on formularies makes it a little bit more challenging to sort of estimate the rate of declines. That decline is really important because obviously the companies have seen this coming and they're working very hard to offset that with new products and next generation products. Potential upside could come if the biosimilar erosion is not as bad as feared and these newer products, including across both businesses from acquisitions, continue to perform well. I will say that there's one other element on the stock itself. The company has been exposed to a bit of an overhang related to long-standing litigation concerns, talc-related injury claims. The company has been in a multi-year process of trying to get this resolved. We would argue that they're probably approaching towards the later innings. And if we can get some clarity on the resolution, that would be very reassuring for investors.
And Chris, there's another company I really want to ask you about. It's not reporting for several weeks. It is Pfizer, but obviously it has gotten a lot of attention for something having nothing to do with earnings, and that's an activist involvement from Starboard. Now, do you think that this is something that is potentially going to prompt better performance from Pfizer? The company has already been sort of embarking on I guess you would call it a turnaround project for itself. So what's your view there?
Yeah, I think when you look at stock performance for Pfizer, it naturally peaked several years back at the height of the pandemic, where the contributions the company made to address the COVID pandemic with a vaccine and the therapeutic Paxlovid were certainly tremendous. The stock, however, has had very challenging relative underperformance over the last few years, and the strategies that the company has been invoking, whether it's through M&A, have generated some mixed results. They recently had to remove a product called Oxbryta from one of their acquisitions. The company has already begun and engaged in a very specific cost-cutting or cost realignment campaign, which I think gives us confidence that we should see some ability to manage on the bottom line in terms of earnings. Two important steps are also yet to be unveiled. One is the company announced the chief strategic officer, who came from Wall Street and has yet to necessarily describe sort of what the playbook will be. And secondly, the company did announce that their longstanding head of R&D, the president of Pfizer Research, and the chief scientific officer would be stepping down. That in any biopharma company is an extremely important and pivotal role, really guides and shapes where the company will go in terms of disease areas, strategies. I think investors are going to be watching that very closely. To your question of activist involvement, it would be unsurprising given where you see the relative underperformance for the stock. But all the things that I already mentioned, outlined, would be some of the most important tactical steps that one could take. I do think that attention to some of these issues does heighten the level of urgency, and that's probably not a bad thing anytime the company is trying to address some of the challenges.
Chris, always great to see you and have you on the show. Thanks for joining us.
Thank you, Julie and Josh. Good to see you both.
Don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.
That's the closing bell on Wall Street, and now it is Market Domination Overtime, sponsored by Tasty Trade. Let's see where the major averages ended the session here as we look at this record streak continuing. The Dow higher by 203 points, about 0.5%. The S&P 500, count 'em, is now at 46th record close of the year, up about 0.75% here. And the Nasdaq Composite actually leading in percentage gains, up about 0.9%. Now, it's a relatively light trading session in terms of volume. That's because it's a holiday for some folks. The bond market is closed today, but we are still seeing this upward momentum here. A lot of earnings are going to be coming out the remainder of the week, and we'll be getting more Fed speak as well. So still a lot for investors to chew on. In terms of today's session, what led the gains here, as I mentioned, the Nasdaq doing the best. We've got the XLK representing tech here, but utilities coming back here. Now, utility stocks are the best performers for this year. They've been sort of wavering a little bit in the last few sessions before coming back today. And then we also got that news that we talked about in the last hour with Alphabet's Google signing a deal with nuclear startup Kairos to try to provide nuclear energy via small modular reactors starting out, well, really in the next decade or so. But that also, utilities were already up before we heard that announcement. But it doesn't hurt matters that we see that kind of demand. And then we're also watching those individual components of the Nasdaq 100. If we equal weighted here, you see just how much of that, how broad the gains were today. Yes, you had some losers, but they were far outweighed by the winners. And going back to market weight here, you see once again this record action for Nvidia. That's the year-to-date chart, but you see it closing at another record high in today's session. We talked earlier to Stacey Raskin, and the analyst talking about that really Nvidia is the only game in town when it comes to the most advanced chips that everybody wants for their AI. So those shares continue to move higher today, but we've got most of the other Magnificent Seven also participating. Josh?
All right, Julie, the market's notching fresh highs to start the week as investors gear up for a busy week of earnings, and tech is back in the driver's seat, leading the gains. Joining us now is Jordan Jackson, JP Morgan Asset Management Global Market Strategist. Jordan, great to see you on set.
Great to be here. Thanks.
So listen, front and center earnings. I'm curious to hear what you think we're going to hear from CEOs and CFOs. On the reports, the conference calls. Do you think they're going to generally just confirm this idea that yes, Jay Powell has stuck the soft landing?
I think they're going to continue to have this sort of benign outlook, right? Mm-hmm. It's not great, but it's not bad either. And so I think in this environment, they can still flex a little bit of pricing power. You can still see the earnings recovery kind of come through for other sectors outside of technology, which I think is really important for the durability of this market rally, right? Mm. So I think CEO confidence is going to, again, be sort of benign. And I think the consensus is that soft landing has been engineered, right? So that's a pretty solid backdrop for risk assets.
Mm. So we're going into earnings season, and we're in an earnings season where companies are for the first time having to grapple with rate cuts, right, and how that's affecting their bottom line. What do you think? What are you looking for? What commentary are you zeroing in on from individual companies?
Yeah, I really want to be focusing in on price pressures, how they're focusing in on margins, right, in an environment in which nominal GDP growth should take a step down over the course of 2025. Every revenue model is probably going to reflect some of that adjustment. So the focus is really going to be on margins. How are they managing input costs? How are they managing wage pressures? Both seem to be sort of easing a little bit, although there could be a bit of a question mark on the input cost side. We do think that the dollar should gradually slide over the course of 2025 as well. That should be a boost to international earnings. Oil hopefully staying pretty range bound or at lower levels bodes well for industrials, transportation. So you kind of can paint yourself a broader picture where this roughly 15% EPS target for 2025 can be achieved. I'm probably somewhere in the low double-digit camp, but that's still a solid backdrop for earnings growth.
And how against that backdrop, how's valuation look to you here?
Still looks expensive, but not screamingly expensive across the board, right? Obviously, mega cap tech continues to sort of drive valuations a little bit higher at the index level, but you can find pockets of value in other sectors of the economy. When you look at healthcare, utilities in and of itself, they're a little bit expensive, but relative to the broader S&P, they still look pretty attractive. When you look at industrials, materials, these are some of the sectors that we like that have really lagged the performance of the broader market, and we think can play a little bit of catch up.
Well, and it's interesting when you talk about valuation, because this is something one of your peers over at Piper Sandler, Michael Kantrowicz, pointed out in a recent chart. He looked at the sort of gap between where we are in PE and where he thinks fair value is, which is below that level. So talking about overvalue, but he says, okay, so we're overvalued. It usually has not necessarily been an obstacle to stocks moving higher. There are other things besides that multiple expansion that can provide that tailwind. How are you thinking about it, and what is going to, do you think we're going to keep going up, and what's going to be that next tailwind?
Well, if this was 2023 and the entirety of the market rally was being driven by valuations and on the hope and the wish that the Fed was going to start cutting rates, I'd be a little bit more worried. But the roughly 22% return that we've seen on the market so far year to date, about half of that has come from valuations coming out, but the other half has come from earnings. And so you've got this sort of durability, I think, from the fundamental side of things, which I think is supportive. Also keep in mind that this is a very different market relative to, say, the early 2000s, where you had a lot of unprofitable tech, and they were pushing valuations higher. Now you've got very profitable tech, and we know growth stocks should command a bit of a premium. So perhaps fair value on the market today is actually somewhere around 18, 19 times, not the historical norm of around 16.5. And so I think that's another dynamic. Now, our valuations are concerned where rates are where they are, and the fact that the Fed's not going to come down very rapidly, sure. But again, as you've highlighted, over the short term, valuations don't really tell you a whole lot about the next 12-month returns.
What, Jordan, does the path of cuts, the trajectory of cuts look like to you, near intermediate term here over 2025? What would be the reaction to the market, do you think, if we did get a pause next month?
Sure. We have to be very humble with kind of rate expectations, and as the bond guy, I've been off sides, right? Like everybody else, more or less, even the Fed. But at least at the current state, we still expect 50 basis points for the year, 25 in November, 25 in December, and 4 25 basis point rate reductions over the course of next year. So that's baked into the cards. That's already in the price, right? The markets have already pretty much reflected that. And so the Fed's got a surprise more hawkish or more dovish relative to that base case. And I think there's an outside risk that they probably respond a little bit more dovish, maybe deliver 5 cuts over the course of next year, because they're going a little bit more concerned around the labor market, and we are starting to see some cracks on the labor side.
What happens to the 10-year? Because it's so interesting in this rate cut environment, and I know that expectations are shifting, but to see yields continue to move up above 4%, do they stay above 4%?
I think so. The reality is, while the Fed is cutting rates, over the course of this cycle, they've also been lifting their long-run projection of neutral. They've gone from 2.5 to 2.9, and the market's estimate of neutral is probably somewhere around 3.5. So, unless the Fed has got to respond to a recessionary environment where they've got to cut rates below, let's say 2.5, 2%, I think I do struggle with an environment of seeing the 10-year down below 4%. Now, I just got off of paternity leave, and so thank you. Before I went on leave, I would have told you the very same thing, and then we got those 2 weaker than expected jobs reports. We dropped to 3.5%, and then we pretty much bounced right back above 4%. So I'm still in the camp that rates probably should be above 4%, particularly given the supply side dynamics as well, where you've got higher deficits, higher debt levels, more Treasury bond supply coming to the market. So you put all this kind of sort of together, I do think the 10-year probably hits 4.5 before we get back down to 3.5.
I'm curious, Jordan, you think politics, elections, a few weeks right now, the possibility to you that we see a relief rally when we do finally have a declared winner, we know who's moving into the White House, or no, it's not that simple. It would depend who's moving into the White House and the composition of Congress.
I think we'll get that fourth quarter relief rally, regardless of the outcome. If you get a VP Harris nomination, I think it's sort of business as usual, status quo. I think if you get a Republican outcome from President Trump getting reelected, I do think the markets might cheer the business-friendly sort of tone that he may try to strike. But really, it's all about this era of uncertainty. We kind of know what will play out over the next 4 years. And so once you lift that air of uncertainty around the election, I think we get a nice rally in the fourth quarter.
Sure, good to see you.
Thanks for having me back.
Welcome back from leave. All right, coming up, Elliott Hill officially becoming CEO of Nike today, but can he get the sneaker giant back on track? We'll discuss when market domination overtime returns, coming up.
Are you a passionate investing bull? Maybe you love scooping up shares of Nvidia on every single dip because, well, AI is changing the game. Fascinated by PE ratios and how the presidential election outcome may impact them? Then come one and come all to the 2024 Invest Conference. Huge power players all under one roof. Thought-provoking discussions on November 12th at 2nd in New York City. We can't wait to welcome you to Invest 2024 live at Yahoo Finance all day.
Nike has a new chief sneakerhead today, with Elliott Hill officially becoming CEO. Hill is a Nike veteran who retired in 2020. He's now tasked with getting the sneaker and apparel giant back on track, and he'll have his work cut out for him. Joining us now is Gautam Mukunda, lecturer of management practice at the Yale School of Management and author of Picking Presidents, among other books. Gautam, it's good to see you again. Thanks for being here. We've chatted a little bit about Elliott Hill before. But now that he's got his first day on the job, what should investors, what should people be looking for in terms of, sort of leadership steps he can take immediately to right the ship at Nike?
So it's great to be back. And I would say that he should start with two things. One is he needs to go all in with what made Nike special, which was its unique culture. The sort of the joke in the industry, right, was that other companies sold shoes and Nike was a religion. And that is the kind of advantage that it's a little hard to beat when you're a competitor, and that Nike has sacrificed over the last few years by focusing on short-term profits instead of being true to its spirit of what Nike is. So he started out that way already, right? He's bringing back other veterans, other people whose history was with Nike when it was that powerful cultural force. And That's what he can do right away. Over the longer term, there are other moves he can start playing. But right now, today, that seems to be what he's focused on, and it is what he should be focused on.
What do you think of looking at John Donahoe? What would you argue were his primary mistakes that he made in his tenure there, in your opinion?
Yeah, so I sort of said that the tragedy of Nike is that it's the same story as Boeing. It's the same story as sort of other great American companies that fall apart. And essentially, he took a company that had enormous underlying assets and decided to, instead of to use it to build a great franchise, to monetize them in the short term. What do I mean by that? Okay, so Nike's smash hit during Donahoe's time was the Panda Dunks. These black and white sneakers that they brought out. They're old sneakers that they brought out from the archives that became enormous sellers. So he's monetizing an old asset, but then they put out model after model, iteration after iteration. And sneaker culture, of course, prizes novelty. So what we saw was within a couple of years, Panda Dunks went from being the thing that everyone needed to wear to being voted at a sneaker convention the worst sneakers of all time. Right? I mean, the worst sneakers of all time. They're, in a weird way, that's an achievement. On top of that, you saw this shift from Nike's traditional dominance of retailers. They push it into, they want people to buy directly from Nike, which improves margins in the short term, but was driven apparently by this belief that people who went to Foot Locker would see there weren't any Nikes and go online. Now, veterans of the industry said, well, no, what's going to happen is they're going to buy Adidas, right? They're going to buy other shoes. But Nike, which had essentially a stranglehold over some of the most important retailers in America, gave it up in the pursuit of short-term advantages to its margins. Third is sort of Nike has always thought of itself as a technological innovator, right? A company that was making better products than its competitors. You can argue that's true or not true. Like I'm not arguing one or the other. I'm saying that's how they thought of themselves. That was how they marketed themselves. And you saw a Nike that just stopped investing in R&D and stopped bringing out new products to the extent that we just had an Olympics. The Olympics are the greatest possible showcase for Nike. And Nike had nothing, just nothing for the entire Olympics.
Yeah, Gautam, so they're trying to sort of recapture this past glory, if you will. As somebody who studies management, a new leader who comes in, who on the one hand, yes, they want to recapture what the company has done. On the other hand, they have to push it into the future. So yeah. How do you sort of tread that line without being too backward looking?
Right. So recapture what the company's done doesn't mean do what the company used to do. That is the path of failure. It's act in the way that is with the spirit of what made the company great. Those are two very different things, right? So you shouldn't just reissue shoes that Nike sold in the 90s and the 2000s. That's pointless. What you should say is, what was the attitude towards making great sporting goods, not just shoes, of course, that made Nike great in the 2000s, and replicate that? And that seems to have been some combination of pushing on technology and telling a story, right? What Nike was the preeminent storyteller in the sporting goods world. Michael Jordan is, those during sort of the peak of Michael Jordan's dominance in the Bulls era, they said that the back of Michael Jordan's head was more recognizable than Bill Clinton's face around the world. That was partly a tribute to Michael Jordan's incredible abilities. It was also a tribute to Nike's abilities as a marketer, right? That is you cannot tell Michael Jordan's story without telling Nike's story. So you want Nike to be run by people who know how to do that. That's the secret.
Gautam, let me ask you this as well. Is it possible to try to estimate how long it would be until we saw the effects, the impacts of Mr. Hill's policies and changes? I mean, do you think is it months? Is it quarters? What do you think?
So I think some things can happen right away, because you can imagine Nike just getting better at marketing, right? People who are sort of more in touch with Nike stories, building some advantages there. I mean, they're already making steps to try and improve their relationships with retailers, right? Getting reestablished at places like Foot Locker matters. But culture is one of those things where when you damage it, it can take a long time to rebuild. If you've starved R&D, it takes a long time to invent new things. It's like a Star Trek view of technology that if you just try harder, these things will happen. It takes time, it takes effort, it takes resources. So you might see some returns in the short term. I wouldn't be shocked by that at all. But if you're seeing a return to Nike's previous dominance, that's going to take a while.
Well, we'll have you back as we watch it. Gautam, thank you so much. Always great to catch up with you.
Always a pleasure.
Thanks. Big Bear AI shares are getting a lift got a lift after the company received a $165 million contract from the U.S. Army, the 5-year production contract to contribute to the Army's digital transformation efforts. In the age of artificial intelligence, we're taking a look at the shifting landscape for decision intelligence with the CEO of Big Bear AI. That is Mandy Long. Mandy, thank you so much for being here. So this contract, first of all, just talk us through the contract, what exactly you guys are going to be doing as part of it.
Absolutely, and thank you for having me back. So this is a long time coming and a huge amount of effort by the team. I'm incredibly proud of this milestone for the company. The basis of GFIM is really about empowering senior leaders and combatant commanders to make data-driven force structure decisions. The intent here being that we can make decisions with greater confidence, and we can ensure that the Army is properly manned, equipped, trained, and resourced.
Mandy, let me ask you, when you're competing for these contracts, who are you competing against? I mean, who's in the bake-off, and what is your competitive advantage there?
So we often, I think, something that we've been working on really hard at Big Bear AI is continuing to move upstream, right, in these competitive bids. The GFIM contract for us is something we've been pursuing for years. We've talked about GFIM for several years in previous earnings announcements. It's a pursuit that we have been on. We've gone phase by phase, and it was a process that was extremely competitive. We went up against a lot of the big boys that are out there, and this is it's a formidable achievement for us because it's a sole source prime award, right? Which for a company like Big Bear AI is a huge milestone moment because it means that we are now in the game, right, at scale as a prime. And I think the key for us, right, is that we have focused for years on developing deep partnerships with our customers. Our folks come from the missions, right? We leverage cutting edge technology, and we leverage our domain expertise over decades and decades of work to deliver solutions that focus on some of the most complex challenges that the DoD faces.
And Mandy, you referred to the big boys, meaning the sort of legacy defense contractors, and that brings up a question for me about sort of where we are in that evolution to that next generation of contractors, and whether the big boys, so to speak, are housing some of that knowledge and ability, or is it more migrating to players like yourselves, or even some privately held companies and other smaller upstarts? Where are we sort of in that continuum right now?
I think some of the recent wins that we've seen, and if I use an example of an exercise that we participated in recently, the Department of Defense T-Rex 24-2, right? That's an exercise that's held. It included, more than 75 new as well as innovative defense technologies. And that did include, right, some of the traditional prime contractors that we see in the space, but it also included a large cohort of transformative technologies. For us, it was a big milestone because as you think about disrupting this space, when we look forward into the adoption of artificial intelligence, the proliferation of pushing that type of technology to the edge, it's why we've been investing in Conductor OS for more than a year. And T-Rex 24-2 was the first time that we were able to deploy that edge infrastructure technology in an operating environment to build a COP, right, a common operating picture for the customer. And it was a breakout moment for the company.
Mandy, AI, it's a tool, and it's a potentially very powerful one. I'm curious, are there certain industries, certain sectors where you think, you're going to see the most disruption in kind of near, intermediate term here?
So this is a bigger question than Big Bear AI, but one that, I've been around as I've seen a variety of different industries attempt to really break into the use of artificial intelligence in productive environments. And that's really the key here. How do you go from an expensive and exciting set of experiments into operational environments where there's tangible ROI? And in industries, one of the industries that I spent, more than a decade in, which is healthcare, I think we saw and have continued to see great adoption in that space of the use of artificial intelligence. Now, one of the things that I stress a lot is that where I believe we're going to see a huge amount of AI adopted across industries is in a lot of those environments where patterns exist, right? Because that's where AI excels today. and the ability to introduce automation in things that have historically either introduced cost or expense, right, to companies, or slowed down time to deliver customer value, right? That's going to be the stuff where we see it first, and then over time, I think we'll move upstream into some of these more esoteric use cases.
Mandy, great to have you on the show today. Thank you so much for joining us.
Thanks for having me.
Time now for What to Watch Tuesday, October 15th, sponsored by Tasty Trade. Starting off on the earnings front, banks kicking off another earnings season with Bank of America, Goldman Sachs, and Citigroup all reporting tomorrow. Bank of America announcing third quarter results before the open. Analysts expecting modest growth in net interest income. They'll also be watching loan demand and expect that to be pivotal to boost revenue in the coming quarters.
Sticking with earnings, we'll also be getting reports from United Health Group, Johnson & Johnson, and Walgreens, among others. United Health reporting results for the third quarter before the opening bell. Analysts will be focusing on star ratings and the opportunity those might present to increase Medicare Advantage memberships and payouts.
And taking a look at the Fed, more Fed commentary tomorrow afternoon from Fed Governor Adriana Kugler. Wall Street will listen closely for any clues about what the Fed's next move could be with interest rates in November.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned.
I run this place with my husband.
Talea is the only female-founded brewery in New York City.
We opened our first location 1 week before the pandemic.
The market changes quickly, the landscape changes quickly.
What we didn't have was money or investors.
So we turned to crowdfunding.
Every incremental sale that we make is a new door we're opening.
We were able to raise about $30,000.
You have to be able to persevere and take the leap.
The plan is to get to 100 locations.
We are here to expand the craft beer market.
Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There is a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. The Dow closing above 43,000 for the first time ever. The broader S&P 500 also finishing the day at a new record. We're diving into the top trends of the day as investors wait for a busy week of earnings. Plus, SpaceX making history. A new device at Elon Musk's Starbase catches super heavy rocket booster in Texas. Closer look at the space race that's ahead. And the soaring cost of insurance in hurricane-prone areas. We're going to hear from one CEO who's directly involved in the cleanup after Milton, even as companies flee Florida. The Dow and S&P 500 clinch fresh highs as Nvidia surges to a record. Also, crypto is rallying and cash is on the sidelines. Yahoo Finance's Josh Schaefer joins us now with more on the trading day takeaways. Josh.
Yeah, Josh, let's start with some of those records you were mentioning. So the S&P 500 hitting another record today, same with the Dow Jones Industrial Average. But I'm going to zoom in on Nvidia and the S&P 500, because what we've seen in Nvidia over the last month, Josh, has been rather eye-popping. So I'm going to pull up that stock here, and we'll zoom out a little bit. So Nvidia closing at 138 today, knocking out its old record of 135. And you zoom out over the last month, the stock's been on a tear. Even the last 2 months since that bottom that we saw in August, again, dipped down after earnings, big pick back up after that. We know OpenAI, there was news on their recent funding round, right? Investors sort of speculating if OpenAI, that big AI product, is getting money into it. They're gonna need more chips. Who makes the most AI chips? That's probably Nvidia. What I think is going to be interesting, though, Josh, is what I just highlighted here. This was the last time we heard about the fundamental story from Nvidia, right? That was their earnings report, and investors sort of, it was a sell the news event. Going into big tech, it's going to be interesting how some of these other companies do, and if these big rallies we're seeing in stocks can hold up when earnings actually come out.
Now, you know what really helps is when your CEO, Jensen Huang, tells press that demand for your Blackwell chip is insane.
Mm-hmm.
That helps.
Yeah, no, it's just been a lot of sort of speculation in some ways, right? Of demand's great, but what are actually
I think you're
the
right.
numbers?
I mean, now when big tech and all the eyes on their conference calls, what do they say about the AI spending plans?
And it will be a lot of those guys, right? We get a look at tech a little bit this week with Netflix. Netflix, obviously not really an AI play per se.
What's it up year to date? Is it 50%?
It's up 50%, I think, about year to date, 46. Zoom out over the last year, though, Josh. Up 100%, right? So this, to me, on Thursday is going to be a good test for, okay, massive rally in a stock. Can the earnings that are expected to grow about 40% year over year, can they still impress Wall Street when you're trading at an all-time high? We'll get a look at that
All right, so
on
subscriber
Thursday.
growth in the ad tier, NFL games.
Netflix has got a lot going for it. Yep. It's just, is it all priced in, right? The other thing that we were watching today in the market, crypto. Mm-hmm. So Bitcoin, Ethereum, both taking off today. And really, Josh, what my takeaway is when I look at a screen like this and I see Bitcoin over the last, we'll put up a 5-day, up about 10% now. Ethereum doing something similar. Then you look at the crypto-related stocks. So a lot of these stocks are stocks that sell cryptocurrencies, right? I'm looking at a Coinbase today, up 11%. Risk on in the stock market, right? We know that crypto and Bitcoin, we could sit here and talk about the pros and cons and debate it, but there's one thing that's always been true, it seems like, when we're getting this Bitcoin rally, it's a sign that people are a little bit more ready to take on risk. And that was some sentiment I think we were seeing throughout the market.
It's also interesting to kind of read politics into it as well, only because Trump really kind of pounded the table. He was the crypto candidate.
Right.
Went after those crypto voters. And you read these reports that the prediction markets have kind of flipped in the last few days. They now put Trump back in the lead. I wonder how much that's playing into sentiment as well.
And what that means for Bitcoin come November, right? Because those are just prediction markets. If that flips again, is a Harris presidency actually bad for the cryptocurrency, or do markets perceive it that way in the interim? It's going to be interesting to watch crypto over the next couple months for sure. Our final takeaway, Josh, this is something I'm writing about in our morning brief newsletter tomorrow. Please subscribe. We're talking about cash on the sidelines. So what this means is people moving into money market funds. You can put your money in a money market fund with your broker, make about 4.5% yield right now over the next year just by holding money there. We've seen a surge since the Fed started cutting rates. So those money market rates have actually come down. This is in some ways maybe counterintuitive, right? Because I'm making less money. I'm making less money on my cash now than I was a month ago, but people are still moving into it. So Goldman Sachs, David Kostin, the equity strategist over there, he took a look at this. He said this is how it normally plays out. People go into money market funds, whether there's a recession, whether there's not a recession, over that 12-month period, because they are trying to figure out what's going on with the economy. So in purple is no recession. People will take that money from money market funds and go into equities. If we have a recession, people want a flight to safety, maybe just grab something that's going to be a little bit more guaranteed, a little bit more safe. They go into bonds. But I think the broad takeaway from this chart is right now people are still trying to figure out where this economy is headed and keeping money in a nimble area where you can go and buy bonds or you can go and buy stocks, but we're still not quite sure how the economic narrative is going to play out over the next 12 months.
All right, Joshua, thank you, appreciate it. Moving on, SpaceX successfully landing its Starship rocket yesterday, marking a milestone for the company. Our next guest calling it one of the most important moments in space history. For more, we're bringing in Rick Tumlinson, founder of Space Fund. Rick, it is great to see you. So let's start right there, Rick. You know, we all watched SpaceX over this weekend, and I did see you post on X, Rick. You said, listen, this is a historic moment. How come? Walk us through it, Rick.
What we're witnessing here is, and thank you for having me, is you know, it's sort of the combination of the railroads, the steamships, airplanes, all in one. Like in 100 years from now, people are going to look back at this period of time as sort of when humanity breaks out into space. I don't know if you're a Star Trek fan, but this is when the Vulcans start looking at us and go, hey, maybe they should join the Federation, right? What I mean by that is the idea of reusability is critical to what it is we want to do in space. What you just witnessed was the equivalent of a skyscraper with a smaller skyscraper on top of it, fly to space, launch the smaller skyscraper, fly back down, and get captured by two pairs of giant chopsticks. It's reusability. The fact that this happened almost begins to make every other rocket on the planet obsolete.
And so now what, Rick? What does come next?
Well, they're going to do a bunch more flights. You know, I've been down there where they launched this thing, and the little Starship vehicle that was on top. Last time I was down there were like 7 more of those. And their approach is to build it, break it, learn from it, build it again. So whenever your viewers see these things blow up, understand that what they're doing, what they say in space is we got good data. They're going to learn more. They're going to get better at it. Elon will probably then take that once it's starting to fly, or SpaceX will. They'll probably start flying their, their communication satellites, their Starlinks. Then if it blows up, it's not a problem. They'll get good at it, develop what we call a heritage, and then they'll be able to start getting into more complex payloads. One of the other big things is they need to be able to refuel in space to be able to go to the destinations like the moon or Mars.
Who would you argue, Rick, poses potential competitive risk to Musk at this point, in either U.S. or Europe, or both?
Not so much Europe. In the U.S., it would be Blue Origin, which is Jeff Bezos' company. He's been moving slow but steady. He's coming up. There's a guy named Peter Beck and his company Rocket Lab, which is not a billionaire-financed company. They're coming up really fast. Peter comes from New Zealand. He was a dishwasher, worked his way into the field. There's an American company called Firefly here in Texas. There are a bunch of them rolling up. And then there's China. China has, at last count, roughly 4 companies that are working on reusability right now. So they're coming up fast.
You know, venture investors, Rick, are much more interested in this space now, excited about this space. I'm curious, how much credit do you give Elon Musk for that?
I give him a lot of credit. He came in with this goal. Single-handedly, he wants to go to Mars and get people there. And he is very obsessed and driven by that goal. Whereas the aerospace industry is like, don't rock the boat, keep the money coming, don't do anything too radical. And so what he's shown us is that just by, remember the old Apple commercial, thinking differently, you could do something that's incredible. But again, the entire community that I know of, the commercial community, the private enterprise, we're moving in that direction, all of us. So once we get past there, Robert Heinlein, the old science fiction writer, said, once you make it to orbit, you're halfway to anywhere. So this is the big one. We get this working, the entire solar system opens up.
And finally, Rick, what about these headlines? I saw reports that California rejecting bids for more frequent SpaceX launches. I'm curious what you made of those reports. How much you think that was some type of criticism of Musk himself went into that decision making?
Yeah, that's a touchy topic. I personally don't share many of his political views right now, but he is a friend, and I think that's a challenge. It's a real challenge. When he just took over Twitter, I tweeted at him before it became X, and I said, dude, you just got one job, and that's get us off the planet. 1,000 years from now, that's all anybody's going to care about. Did you get us off the planet and break us out? We need to see that happen, and we need politics on both sides to get out of the equation. Both sides. Let's just go.
Rick, great to have you on the show. Thank you so much for joining us and your perspective. Appreciate it.
Thanks.
Yahoo Finance Podcast, Money Glow Up, breaks down the misunderstandings we tell ourselves about money. Tiffany Aliche will be your favorite personal finance educator as she helps you transform the way you think about money. Tune in every Thursday at 12 p.m. Eastern. Stick around, more Asking for a Trend on the other side.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capital Gains. We're on for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Hurricane Milton projected to be among the top 5 costliest natural catastrophes in the U.S., according to Morningstar DBRS. Insured losses forecast to approach $60 billion as severe weather remains an overhang risk for insurers. Heritage Property and Casualty Insurance CEO Ernie Garate joins us now with more. Ernie, it is good to see you. With Hurricane Milton, Ernie, I've seen different estimates for potential insured losses here, but I am curious to see, what are you all seeing on the ground in Florida and how is it impacting your company?
So thank you for having me, Josh. And first and foremost, our thoughts go out with the folks from the Tampa Bay area. Myself, I live in Tampa Bay, so we've experienced this firsthand. So what I will say, Josh, it's a little bit early in the process. We've had reported claims. We have people on the ground. I think you can see from the storm, it just went south of the Tampa Bay area, not a direct hit on Tampa. And we are seeing claims coming in. But I will say it was not a direct hit, and we're still analyzing. Now, the models are all over the place. You've seen numbers as low as 25 to 30 billion and as high as over 100 billion. Our focus right now is addressing our policyholders and getting them back.
What, Ernie, do these hurricanes, in your opinion, as you look ahead, what in the future do they mean for the cost of property insurance in Florida, just going forward?
Yeah, what I would say, though, if you look back at 22 and 23 with the insurance reform that happened in the state, it did stabilize the market and it did better capitalize a lot of insurers and reinsurers for this market. So we're committed to the market. I think the market will continue to be strong. As you take a look at the market itself, new capital has come in. Reinsurers have provided more capital to the state of the market. And I think this is a storm that's manageable for insurers in the market.
And Ernie, when you mentioned that reform in Florida, what specifically can you tell us about that? What changes were made?
Sure. So there are a number of changes that were made, and one is the reporting period. Florida was the only state that it would give you 3 years to report a hurricane claim. That's down to 1 year, and that's to make things more manageable and not have these claims coming in. The other was the one-way fee statute. The amount of litigation abuse that happened in the state of Florida is something that's very costly, and policyholders paid for that, throughout the period of time.
If I own a home in Florida, Ernie, I have property insurance, what would that typically, I'm just curious, what would that typically cover? Would that specifically address, water, flood, hurricane-related damage?
So it typically covers the wind, right, on that piece of it. We do not cover the flood. Flood is through the national program, NFIP, on that aspect of it. And one side is if you're closer to the water, you've got to expect a higher price. It is the price for living in Florida, living close to the water, which is beautiful. As you go inland, those prices become more affordable.
And what are the different variables that also it can impact the cost, Ernie? Is it trees over your house? Is it the age of the roof? What else goes into that?
Yeah, I think one of the things that Florida has done a really good job that we're seeing with some of these storms is the construction code. So it goes all the way back to Hurricane Andrew, and Miami-Dade County passed some pretty strict construction codes, for buildings. That has migrated throughout the state. And just to give you a couple of ideas, we've seen winds of over 100 miles per hour where, yes, you're seeing missing shingles, but you're not seeing the extent of damage to the roof. So the building construction has gotten better. We always tell policyholders to trim those trees back, right, and make sure that you're up to code.
Ernie, finally, I got to ask, because it did get a lot of attention. 60 Minutes aired this piece. It was late last month, and whistleblowers talking about Hurricane Ian, Ernie, and several insurance carriers used altered reports to deceive customers, lower payouts. Heritage was one of those highlighted in that story. Ernie, what can you tell us about that?
So what I can tell you, the altered report is absolutely false. I can't speak to the specifics of it because we are in litigation, but I can tell you we're committed to our policyholders, and we've paid out billions of dollars, to all our policyholders when it comes to these events, and we'll continue to do that.
Ernie, thank you so much for joining the show. Appreciate it.
Thank you, Josh.
And coming up is the S&P 500 overvalued. We're going to break it down in our chart of the day on the other side. Stick around. We're asking for a trend. Still to come.
Are you a passionate investing bull? Maybe you love scooping up shares of Nvidia on every single dip because, AI is changing the game. Fascinated by PE ratios and how the presidential election outcome may impact them? Then come one and come all to the 2024 Invest Conference. Huge power players all under one roof. Thought-provoking discussions on November 12th at Second in New York City. We can't wait to welcome you to Invest 2024 live at Yahoo Finance all day.
We are zeroing in on valuations for our chart of the day. Yahoo Finance's Julie Hyman joins me now with a closer look. Julie.
Thank you, Josh. Well, today's chart of the day coming to us courtesy of Michael Kantrowitz over at Piper Sandler, the strategist there. And he too is looking at valuations, but his note was titled, "Valuations are getting high, so what?" In other words, we are seeing the price to earnings ratio for the S&P 500 climb above what he sees as fair value. That said, he still thinks stocks can potentially move higher from here. So let's take a look at the chart here. What we have is the price to earnings ratio for the next 12 months for the S&P 500. That's the purple line. And then his own forecasted price to earnings ratio, where he sees fair value for the S&P 500. So obviously here we are seeing where it's actually trading above where he thinks it should be trading. He thinks fair value for the S&P, by the way, is around 20, which is above historical average PE, but we're trading a couple points above that right now. Why does he think stocks can continue to move higher? He says particularly individual stocks are seeing their earnings growth to justify those valuations and to push things even higher here. And that was a sentiment echoed by Jordan Jackson of JP Morgan Asset Management when we spoke with him earlier about this phenomenon of valuations looking lofty on the surface. Here's what he said.
Also keep in mind that this is a very different market relative to, say, the early 2000s, where you had a lot of unprofitable tech, and they were pushing valuations higher. Now you've got very profitable tech, and we know growth stocks should command a bit of a premium. So perhaps fair value on the market today is actually somewhere around 18, 19 times, not the historical norm of around 16.5. And so I think that's another dynamic. Now, our valuations are concerned where rates are where they are, and the fact that the Fed's not going to, come down very rapidly. Sure, but again, as you've highlighted, over the short term, valuations don't really tell you a whole lot about the next 12-month returns.
Yeah, and I think that last bit is an important point, Josh, because you and I hear strategists all the time talk about valuations as a concern, but most of them don't say valuations alone will keep stocks from moving higher.
And it was interesting too, Julie, you can talk about valuation of the broad market, but of course under the hood you can always see opportunity. And Jordan talked to us about, still different sectors he would find attractive here. I think he mentioned healthcare, industrials, tech.
Yeah, exactly. And that's a note that Kantrowitz made also, that you have to look at sort of individual stocks even, not just on a sector basis, but on an individual basis. Look at their earnings growth profile to see if investing in them makes sense.
All right, Julie, thank you. Appreciate it. And that is a wrap on today's Ask for a Trend. Be sure to come back tomorrow, 4:30 p.m. Eastern, for all of the latest market-moving stories affecting your wallet. Have a great night.